Folks, this is serious. We have a major indicator that has never been wrong. 100% track record in predicting recessions is now flashing red right now. We have to talk about it. We have to cover it. It doesn't mean we're going to get a recession. There's a lot of counter arguments here. Even the creator of the rule is actually saying, hey, this might not be so accurate this time around, but that's for the rest of the video. We have to start with, first of all, going over what happened this week, what's going on with the recession fears, what is the outlook for the next week, the next months, the next 6 months, and the next 2 years. A lot to cover today. This is a very important video. I was hoping not to make it on a vacation, but I gotta come out with this stuff because this is super important. Now, over the past week, the craziness just amped up as the week went along. I mean, we had the IWM down 7%, absolute insanity. Tom Lee is, I don't know where, in the bunker at this point. We have the S&P 500 and the NASDAQ down significantly. We have unemployment rising to 4.3% all of a sudden. And we have the SAM rule, which we'll talk about in a second, which has never been wrong before, indicating recession. And on top of it, we have war potentially brewing up in the Middle East between Iran and the Israelis. And if all of that was not enough, for one single week, Warren Buffett decides to sell 50% of his largest holding, Apple. And that basically puts Warren Buffett in a major cash position like we haven't seen in a long time. And that's also another massive indicator that trouble is ahead. So all of this is happening, but it doesn't mean we're going to get a recession. It doesn't mean that the market is going to go to the toilet. The point of this video is actually to show you what's really going on without any copium, or without any fear, uncertainty, and doubt, and mongering just to get clicks. This is real data, objective stuff to show you everything, good and bad. Now, 4 days ago, I made a video before I went on vacation on Tuesday, and you can go ahead and search it right now. And I said, look, guys, I'm going on vacation, but just as I'm about to leave, the market is flashing red. Everything looks great, but there's a major indicator flashing red about the S&P 500. You better watch out. I don't know what's going to happen. It might not happen, but if the market crashes because of this indicator, you better mitigate the risk. And I suggested that if you agree with my analysis, maybe consider selling a third of your biggest winners just to get some insurance. Now, some people mocked me, some people made fun of me, some people got angry, whatever the case may be. I don't care. I couldn't care less. It's like the people who complain about clickbait. I don't care. The thing is that investing has nothing to do with emotions or liking me. You can like me, you can dislike me. It's about making money. A lot of the people who watch that video listen. How do I know this? Because the like to dislike ratio was 97%. So 97% of people actually listen, and I hope that they mitigated the risk and actually did the stuff that I talked about in the video, and now they're doing better than the people who got butthurt and let their emotions and ego rule. This is all about investing. It's not about what do you think about my personality, my voice, or my face, or even my beautiful hair. Now look, before we start this video, I want to welcome the new 18,000 people that joined this community over the past 28 days. It's a lot. Now, that's the reason why we stopped the Academy. We can no longer accept new Academy members for the next, give or take, 25 days. It's just got overbooked, oversubscribed. But because people have been bombarding me with DMs about the Academy over the past few days, we have opened up 3 spots. 3 spots. That's the only openings we will have in the Academy until September 1st. The Academy is closed until September 1st, but we have 3 spots left that we're going to open up as of the making of this video. Those will be open. Once they're filled up, they're gone. No more Academy memberships until September 1st. Now, you can join. The details are going to be below somewhere. I don't have an editing software here that's not edited, so it's on the description, patreon.com/Tom Nash. Go check it out. If you have a spot and grab it, good. If the spots are filled, just join the Discord. It's free. It is 100% free. There's no upsell. Discord.gg/Tom Nash. 15,000 members talking about these things every day. It's a major resource that you can have in your toolbox for free. So you could always join Discord. It is free. And then in September, if you missed it, you can rejoin the Academy. Now, let's go back to what's going on with the market. Enough with this stuff. Look, first of all, everybody got wet. It got very rainy very quickly, and everybody got wet. You know, the Bitcoin camp took an 11% hit, but that was mainly because Trump and Harris are now neck and neck. All of a sudden, the race got opened up again. I, for one, thought that Trump is going to win, But now that Harris has this massive media push behind her, the race is wide open again. So the whole, Trump is a Bitcoin maximalist and he's going to win, that's now uncertain. So the market dropped 11% on Bitcoin. And, that's part of the game. Microsoft was down 4%, Tesla down 5.5%, Amazon down 8%, and my beloved Palantir is down 10% ahead of earnings. This is a really painful situation. On top of it, we have Apple selling off, but the weird thing is that Buffett selling 50% of his Apple position really did nothing. If you look at the stock over the past 5 days, it's up by 1%. So what gives? Well, Buffett has this Buffett effect. When he sells, people sell, just the way it is, That's why Buffett gets to sell quietly and just report it retroactively after 90 days, which is what happened here. So he sold over the past quarter quietly. And now you're going to see the selling pressure following his sale probably on Monday, because people like to copy Buffett, and it's, it is what it is. I, for one, don't do it, but hey, a lot of people do, and that's why people will sell on Monday. The funny thing about this whole thing is that if Buffett would have, stayed, if he would have kept his position, he would have made another 30 billion in this quarter because Apple actually went up quite significantly. So there's that. But whatever you say, however you spin this, Buffett going cash heavy, liquidating his biggest position, is not a good indicator for the market. You can't argue it is. It's just facts. You have to accept it. Now, does it mean we're going to get a recession and a market crash? No, but it's a bad indicator we have to take into account as smart investors. Now, I want to talk about the SAM rule. Everybody's now quoting the SAM rule, talking about, this rule basically predicts 100% recessions. It's not been triggered. I guarantee you that 90% of the people who are talking about this rule right now, writing about it, posting about it, making videos about it, they haven't heard about it until yesterday. I promise you that. Now, Claudia Sam actually came out and said, for those of you who don't know the story, she came out and said, hey, look guys, I know it's triggering right now, but based on what I'm seeing, this might not be as evident as people think. So this year might be actually different. And she's the inventor of the rule. So I'm going to explain everything right now. So basically, Claudia Sam, she has a Substack, by the way. So she came up with this indicator, and if applied all the way back to 1953, a recession happened within a few months from the triggering of that specific rule. The rule being very simple. Once the 3-month average goes more than 0.5% above the 12-month low of unemployment, then this rule gets triggered. So basically, once you have the 12-month low, but the 3-month average moves half a percentage point above it, that's the triggering event. That's significant. That happened with the 4.3% unemployment, and now everybody's saying, well, look, Tom, since 1953, 11 other times, this thing basically got 100% accuracy rate. And that is true, even though in 1959, it didn't really work like that, but that's besides the point. That's minutia. Now, Claudia Sam actually came out on her Substack, and she said, look, guys, I'm the inventor of the rule. Listen to me. 2024 might be the year where this thing actually fails, because a lot of this unemployment is not recessionary. A lot of this unemployment comes from people quitting post-COVID, getting new things to do that don't have like a proper job environment, and a lot of people resigning and still sitting on cash. But most importantly, what she's saying, look, most of all, we have a lot of immigration here over the past 4 years. The United States have been bombarded with immigrants over the past few years. Some of it is legal, but a lot of it is illegal. That's a political hot potato. I'm not going to get into this in this video. Not that I mind offending people, just we don't have the time. But basically saying there's a lot of new immigrants coming in, and that contributes a lot to unemployment rising. And that isn't recessionary. That is not something that comes from the structure of the economy, but just too many people that are coming through the border, and not all of them have jobs. That doesn't translate to recession right away. So that's what she's saying. Take it with a grain of salt, but do think about it. Moving on. Whatever you want to say about Claudia Sam and the people who are quoting her, or the Tom Lee camp, ultimately, this is the situation we have right now. If you are a bear on this market, this is what you see. Unemployment is at 4.3%. That's high. Buffett is going cash heavy, selling his biggest winner. That's not good. Rates are very high right now at 5.25%, and the Fed has decided to keep them until at least September. Sorry, that's not good. The SAM rule, which has a 100% accuracy rate, got triggered. Not good. Now, that's your bear outlook, right? But if you're a bull, you're looking at this market and you're saying, well, look, the yield curve is still uninverted. Every time we have the yield curve invert, that doesn't cause a recession. The recession comes after the yield curve gets uninverted. We haven't uninverted yet. So that's number one. Number two, GDP, the gross domestic product of the United States, is growing at 2.8%. That's 0.8% above the forecast and double than the growth rate we had in the previous quarter. Consumer spending is up 2.3%. That's way higher than the 1.5% we had in the previous quarter. Inflation is at 3%. It's not very high. So we're growing nicely. People are spending nicely. Inflation is down to almost 2%. And we have 80% of S&P 500 companies beat earnings per share. That's a lot higher than the 74% average we had over the past 10 years. So overall, looking at all this data, there's a lot of good and also there's a lot of concerning signs, but they're almost identical in weight. So you can make a case in either direction. So looking at the the yearly performance of the main index, the IWM, the S&P 500, and the Nasdaq of each industry, you can kind of get a perspective of where we are right now. A lot of fear, a lot of uncertainty, but also basically over the past 8 months, year to date, IWM is up 5%, S&P 500 is up 13%, and the Nasdaq is up 14%. So basically, the market so far, year to date, is doing above average. It's definitely right now, over the past week, in a correction territory. But the big question here, will this continue? Is this a temporary correction? Or is this the beginning of a recession and a market sell-off? So let's learn history here. Let's not be emotional, because that's the biggest mistake of new investors. You see, the Fed has kept rates very, very high for a very long time. That's a fact. Also, the Fed will cut rates in 2024. That's also, by this point, a fact. No matter what people are telling you, that is a fact. Now, usually when the Fed cuts rates for the first time after a prolonged period of elevated interest rates, the market does way, way better when there is no recession. So basically, the answer is, when the Fed cuts rates, does it take the market up or down? The answer depends on how good the economy is. If there is no recession, the Fed first cut leads to a 40% spike in the S&P 500 of the following 12 months. So if there's no recession and the Fed cuts 40% S&P 500 for 12 months, great. But if there is a recession when the Fed cuts rates, then the market does negative 5% historically over the next 12 months. But over the next 24 months, it basically breaks even. So as a long-term investor, at least as a long-term investor, there's really nothing to worry about. You're either going to get 40% in 12 months, or you're going to get a pullback, and then within 2 years, you're going to be back 0.0%. So you're not going to lose any money over the next 2 years. But you might be behind the curve a little bit if you stay. That's the whole situation here. It's not as bad as the fear-mongering clickbait on YouTube making you think. Now, I've used this clickbait technique myself multiple times, and I'm going to continue to use them. But I use them to bring the people into my videos so they can listen to the actual factuals and not to the idiots who are selling them fear. And if you don't like it, sue me. I don't care. Look, rate cuts don't cause recessions. Rate cuts don't cause the markets to crash. That's not the point. Correlation and causations are completely different things. Now, when the rate cuts are coming along with a poor economy, you're going to see a market do bad. When the rate cuts come with a great economy on the side, you're going to see the stock market do well. That's the whole story here. Nothing above that. Now, I've told you 4 days ago to take a third off the top if you agree with my analysis. It's your decision ultimately, but I gave you my analysis. But I've also told you in that video that the most important thing here to remember is that overall, what you need to be keeping doing is dollar cost averaging, whatever the case may be. If the market does great, you dollar cost average. You spend, let's say, $100 every week on your favorite stock. 100 every week, or every month, or every quarter, whatever that may be. But if the market drops significantly and goes into the red, you keep buying at a faster pace. So now you're buying at 200, 200, 200, 200. That's the whole story. And for the people who are saying, well, Tom, maybe we don't have the money to double down. Well, go watch some of my videos and go join the community and watch the videos we have on Patreon, where we explain how you manage your household budget, whatever money you make, whether you make $50,000, $20,000, or $100,000 a year or more. No matter what your budget is, you can always structure your household budget in a way that allows you to double down and DCA at a faster pace with cash on the sideline when the market drops, no matter how much money you make. Go watch the videos in the community, watch the videos on Patreon. It's all explained. Now, the recency bias I'm seeing in the market is a chance for you to learn and earn. You see all the chicken heads running around for the hills, screaming, we're all gonna die, basically panicking. What you're also seeing right now is the people who have been in my community for the past 2 years, buying the dip, dollar cost averaging like ninjas, zero emotions, zero fear. They're laughing at this, basically saying, no problem, I'm gonna slowly DCA into weakness. That's the whole point here. You have to learn to be absolutely agnostic to the recency bias and the craziness that's going on in the market right now. I just showed you there's data in either direction. There's data that shows good, the data that shows bad. But to say, oh my God, this is over, it's the end of the world, and just to sell everything, that's not how investing works. You have to be smart. So while everybody's panicking, my students are basically buying the dip like ninjas and laughing at this dip. Now, I just want to point out, historically speaking, while it is true that August isn't supposed to be a bad month in an election year, it's supposed to be a decent month, and so far it hasn't been, but the month isn't over yet, so we'll see. The best months in an election year have been always, statistically, historically, November, December. The big parabolic spike of an election year always comes in the 11th and 12th month of the year. So that hasn't happened yet. And it's important that you remember the rule I told you in previous videos. If you miss out on the top 10 days of the past 20 years, your return will be slashed by half. Staying in the market is very valuable. Now, a lot of people have said to me, well, Tom, what if you miss the worst 10 days? Well, yes, that is kind of true, but here's the problem. While I can guarantee a system that gives you 100% participation in the best 10 days of the market, which is just staying invested, I can't give you any tools that will guarantee 100% of you missing out the worst 10 days. How can you predict missing the worst 10 days? You can only do that by timing the market, which is literally impossible to predict. So while technically you guys are right, missing the worst 10 days will also be super beneficial, but it's impossible to achieve. Well, basically getting the best 10 days is super easy. Just stay invested and dollar cost average and wait. I just showed you. Even if the market crashes because of the Fed cuts, because the economy isn't good, in 2 years you're gonna bounce back and be wherever you started this journey. So you're not gonna make a lot of money, but you're gonna be broken even. That's the whole point here. It's all about patience. It's all about stoicism. It's all about just staying calm in the face of the screaming people running around, running for the hills, shouting the world is over. Just stop this. Take a break, drink some coffee, enjoy life. Don't look at the app too long. Put a buy order for DCA and forget about it. Simple as that. Now, just to kind of recap this. Number one, Discord is wide open for everybody to join. Discord.gg/Tom Nash. Academy spots, 3 left. We opened 3 right now. The minute this video goes live, we have 3 spots left. They're gonna be gone quick. And once they're gone, no more Academy spots until September 1st. How to join? It's all in the description. I'll see you in the next one. Peace.